In this lecture, we will cover the CFA Level 2 reading on equity valuation, applications, and processes. This is a relatively straightforward reading. A lot of what you'll see here is material that you have also seen at Level 1, but there are a few important aspects which I will emphasize. The first point that we will talk about is the definition of value, and obviously this is value in the context of equity valuation. Here are a few terms you need to learn. Intrinsic value. This is the true or real value of an asset or security given a hypothetically complete understanding of the asset's investment characteristics. Why do we say hypothetically complete understanding? We say this because we can never have a complete understanding of an asset's characteristics. Therefore, we can never be 100% sure about the true or the real intrinsic value of an asset. But nevertheless, we can try to collect as much information as possible and come up with a value that would be a perceived value. We are going to denote intrinsic value with the symbol V. The current market price of an asset is given by P. For simplicity, we'll assume that we are talking about a publicly traded stock. So the current market price P is easily observable. In an efficient market, the price in the market will be equal to the value. So this would be a completely efficient market. But all markets are not necessarily efficient and all assets are not necessarily priced efficiently. So there might be some mispricing. That mispricing is equal to the true intrinsic value of an asset minus the market price. Then, as I said, we cannot be 100% sure about V. So what we then talk about is perceived mispricing. This is the difference between the estimated intrinsic value and the market price. So let us denote the estimated intrinsic value as VE. So VE minus P, this is the perceived mispricing. And if we do a little bit of algebra, so we say that this is equal to the same thing plus V minus V. So algebraically we are covered. And then this expression can be divided into two components, V minus P and VE minus V. What is this telling us? This is telling us that the perceived mispricing has two components. One is the actual mispricing, which we cannot be completely sure about, and the other is the difference between the value that we are estimating and the true value. If you are an active investor and you are trying to identify underpriced securities, then for you to be successful in the long run, two things need to happen. The first is that V and P need to be different in the sense that obviously in a completely efficient market, the value will be the same as price. So the assumption is that you are operating in a market that is not efficient. There you can make abnormal returns. So there needs to be a difference between V and P. The other is that this term, the difference between your estimated value and the true intrinsic value, should be as low as possible. Ideally, if this is close to zero and the assets are underpriced, which would mean that P is relatively low and the true intrinsic value is relatively high, then you as an active manager will make money. So that is stated like this in the curriculum. For active investing to be successful, your estimates must be different from consensus estimates and must be correct. In this context, consensus estimates would represent the market price, because market price is generally based on what the majority is expecting. So that would be consensus estimates. Next major point is the distinction between going concern value and liquidation value. You have seen this at level 1. When you value a security, you make an assumption that this particular company is going to go on forever. Even accounting numbers are based on going concern value. The opposite of going concern value would be liquidation value. Liquidation value is where you say that I'm going to liquidate the assets, I'm going to then settle the liabilities, and what remains is the liquidation value. You as an analyst need to know which method needs to be used in what scenario. If you are evaluating distressed securities, so these are companies that are maybe likely to be liquidated, then does it make sense to use the going concern value or liquidation value? Obviously, it makes sense to use the liquidation value. Going concern value is what you would use when you are coming up with the value of a regular company that is expected to go on for a long time. The next important distinction is between fair market value and investment value. Fair market value is the price that one party will pay another party, where both parties are willing and neither party is being forced into the transaction. So that is called a fair market value, and one generally assumes that when stocks or other investments are trading, they are trading at fair market value. Investment value is the value of a particular security to a particular investor. As an example, if you are a large pharma company and you want to buy a small pharma company where you believe that there are considerable synergies when you absorb this particular company, then we might say that if you are the investor, you are the big pharma company, your investment value might be higher than what others are willing to pay. So in that case, note that the investment value is the value that you as a strategic buyer are placing on this investment. And it might not necessarily be the same as what other people are willing to pay for this same investment. Also, sometimes you might have real estate investments where the value can differ based on the tax rates of different investors. So when we consider the characteristics of the investor and then come up with value of a particular asset or investment, then that is referred to as the investment value. Section 2.2 deals with the applications of equity valuation, and this is fairly straightforward. I'll just run through the list presented in the curriculum. The first obvious application is selecting stocks. When you buy stocks, you need to figure out whether the stock is overvalued or undervalued. So you will use the sorts of equity valuation techniques that we will cover over the next few lectures. Another application is inferring market expectations. What this means is that you look at the market price, and based on the market price and certain other inputs, you infer what the market is expecting about a given stock or a given investment. I'm not going to cover example 1, but I'll just give you the essence of this example, which will illustrate what I'm talking about. Example 1 deals with Intel stock, and you as an analyst believe that the market is making certain assumptions about Intel stock that are overly aggressive. One of the assumptions that you are concerned about is the growth rate that is implied by the current price. So here is what you do. You assume that the dividend discount model is an appropriate model to value Intel, and specifically you use the Gordon growth model. If you recall from level 1, the Gordon growth model says that the price of a particular stock is equal to D1, which is the upcoming dividend, divided by the required return minus the growth rate. Now, if you are concerned about the growth rate that is implied in the current price, what can you do? You can take the current market price and plug it here. You can take the expected dividend 1 year from today, plug it here. You can plug in the required return for Intel. Maybe you calculate this using CAPM. And then you calculate G. That G would be the G that is implied by all the other company-related variables. Example 1 says that when P, D1 and R are plugged in, the value that we get for G is 20%. Now, if you as an analyst believe that this 20% is much higher than what can be realistically expected for a company like Intel, then what does that say? That says to you that probably the price is in the market is much higher than what it should be. So note that you have used an equity valuation technique to infer certain expectations about the stock. So this is another utility. There is a question at the back of the book that asks about the distinction between how you use equity valuation to select stocks and how do you use equity valuation to infer market expectations. And hopefully that became obvious here. The distinction is in the numbers that you plug in. With selecting stocks, you will plug in company-related numbers and try to figure out what the right price or what the right value should be. When you want to infer something about the characteristics of the company, then you also plug in the current market price and other variables that you have more confidence about, and then you figure out what the implied growth rate is. Continuing with the list, you can also use equity valuation techniques to evaluate corporate events. We have talked about this in mergers and acquisitions. If you are a large company and you want to acquire another smaller company, you will use equity valuation techniques to value the smaller company. You will use these techniques to figure out the value of your larger company post-acquisition and so on. Rendering fairness opinions. You might be an analyst who is advising a large company as to whether the price being proposed for a certain investment is fair or not. How will you do that? Again, you will use equity valuation techniques. Evaluating business strategies and models. Ultimately, the goal of senior management is to maximize the value of a firm. And obviously, you use equity valuation techniques to come up with the overall value of a firm. So you can see what will happen to cash flows and other relevant variables if different strategies are implemented, and then pick strategies that will maximize overall value. The concepts that we talk about here are also important when we communicate with analysts and shareholders. They are important when we come up with the value of private businesses. And finally, sometimes employees are compensated based on the share price. What if the share price is not publicly available? You don't have a publicly traded company. Then you will have to use some of these techniques to say, okay, we estimate that the value is so and so, and then compensation is based on that estimated value. We now come to section 3, which deals with the overall valuation process. Here is what we need to do, and over the next few slides, we will take each of these items. Let's start with understanding the business. There is nothing overly new over here. When you want to evaluate a company, the first thing to understand is the context around that company. And the context for a company is defined by the industry and the competitive environment in which that company operates. There are actually other readings in equity that cover this topic in a lot more detail. Later there'll be a reading on Porter's 5 forces, which deals with industry analysis, and then there is a full new reading which deals with industry and company analysis. So what you will see here is just a small subset of subsequent readings. So you might wonder why the CFA Institute has overlapping material. One answer is that this is a relatively old reading. It's been around for a while. And then the other readings that I just referred to, especially the industry analysis, has been introduced for the first time in 2014. So it's an important topic. Anything that appears more than once in the curriculum is probably more likely to be tested. Also, you can think of this as a summary of the critical points. You need to understand the attractiveness of the industry. There are several ways of doing this, but the CFA Institute's favorite method is to use Porter's 5 forces, or Michael Porter's framework. And as a quick review, we've seen this at level 1, and we'll see it again in detail, but I'll do a review over here. What are those 5 forces? One force is internal rivalry. So within a given industry, how competitive are the firms? If you have lots of firms competing, then the rivalry will be high. Then there is the threat of new entrants. Obviously, if the threat of new entrants is high, then if that force is strong, then the pricing power will be relatively low for the players in the industry. There is the threat of substitute products. There is supplier power and customer power. In an industry where all these forces are strong, such as the airline industry, then the pricing power of the players in the industry will be relatively low, which means that profitability numbers in those industries will be relatively low. Once you have figured out the overall competitive position of an industry, you also need to be aware of the company's relative competitive position and strategy. Within a given industry, you might have players like Intel and AMD. So we just talked about Intel. So they are in the same industry, but they have different strategies. Intel, for example, likes to be innovative. They will be the first to come out with a new kind of chip. AMD, on the other hand, follows the leader. So they will have different R&D expenditures. They will have different marketing expenditures, for example. So you need to understand the strategy of different companies. And then you also need to understand how well companies execute their strategy. So ideally, you would like a company in an industry which is profitable, where these forces are relatively weak, a company with a very logical and sound strategy which is being executed well. Next, we talk about the analysis of financial reports. We have spent a lot of time on this in financial reporting and analysis. The simplistic point is that when you are evaluating a company, you need to study the financial reports of the company, maybe the financial reports of competitors, and so on. The next point is, what are the sources of information you look at? The first source of information obviously is the financial reports presented by the company, but then there might be publications or information issued by the industry itself. So most industries have some organizations that represent that particular industry. You can look at information presented by those industry organizations. You might have third-party entities like Forrester and so on that present information which analysts can buy. So there are several sources of information. And then this is important. What are the considerations in using accounting information? A lot of what you see here is material that you have already covered in financial reporting and analysis in the reading on earnings quality. But this particular segment highlights 2 points. The first is that you need to be aware of the quality of earnings. And this part actually is straight out of the reading on quality of earnings. So is the quality of earnings good? In other words, is the information being presented indicative of the true economic reality of the firm? If so, then that is good. If not, then obviously you should be concerned. The other key point is the sustainability or persistence of earnings. When a company reports earnings in a given period, and there are several one-time items, let's say that the one-time items are positive one-time items. Maybe there was an unusual tax break, or maybe there was the sale of an asset which is not normally sold. That would make the earnings for a particular period higher than usual. You as an analyst are concerned with what will happen in the future. So what do you do with one-time benefits or one-time expenses? In projecting future numbers, you need to ignore those one-time items. And the term that is often used is adjusted earnings. Adjusted earnings would be earnings after removing any one-time unusual items. There are several useful examples and exhibits. I'd suggest that you go through them if you have time. Example 2 deals with a competitive analysis related to the oil field services. I don't think there is anything overly new here that you will not see in other readings, so do this if you have time. And then Exhibit 1 deals with selected quality of earnings indicators. So what are the warning signs that you need to look at? I'm not covering this here because this same material is covered in FRA. And then Examples 3 and 4 deal with quality of earnings warning signs. Again, I would suggest that you read this, and if you find this new or if you find this difficult, then that means that you've not done the FRA material carefully enough. So then you need to go back and make sure that you are on top of FRA. And hopefully you will note here that there is a close link between FRA and equity, because one of the most important aspects of equity analysis is to be able to analyze financial reports. Moving now to forecasting company performance. Now again, this is material that is covered in a lot more detail in the reading on industry and company analysis. But here I'll just make a high-level point. When we forecast, there are two broad approaches. One is to use a top-down approach, the other is to use a bottom-up approach. In a top-down approach, you first look at international or national macroeconomic forecasts, then based on those you look at industry forecasts, and then you come down to company forecasts. In a bottom-up approach, you start at the company level. So if you are evaluating a large retail chain, what are the changes in sales going to be on a per retail outlet or per shop basis? Then you might project the rate at which the number of retail outlets will increase and so on. So that would be an example of a bottom-up approach. Selecting the appropriate valuation model. Again, most of these valuation models have either been covered at level 1 or will be covered in detail later in level 2. Broadly speaking, we have absolute valuation models and relative valuation models. Absolute valuation models come up with the value of a company based on information related to that company. Here are some classic examples. The DDM stands for the dividend discount model. When do you use this? You use this model when a company makes dividend payments, and those dividend payments are closely aligned with the earnings of the company. If a company makes dividends occasionally and those dividends are generally not in line with earnings, then it doesn't make sense to use the DDM model. If a company does not pay dividends, then another model that you can use is the free cash flow to equity model. Here you figure out the cash that is available to equity holders after working capital investment and fixed capital investment, and then you discount that cash flow to equity using the required return on equity. And the number that you will get, or the value that you will get, is the value of equity. Another method is the free cash flow to firm method, where you evaluate the total cash flow available to all providers of capital. This would both be equity holders and bond holders, and then you discount the cash flow using WACC. I'm covering this briefly here because there is a full big reading later that talks about valuation using cash flows. There is also a very long reading that deals with valuation using dividends. There is also a reading on residual income. What this says is that you can look at the residual income, and roughly speaking, residual income is defined as the income that's generated minus an equity charge or minus a capital charge. I'm not going to go into more detail here because we've touched on this in corporate finance, and we'll see this in detail later. And then finally, asset-based valuation. Here we look at the assets of a particular company and then essentially value the company based on assets. A company with very liquid assets, where most of the value of the company is coming from the assets, would use the asset-based valuation method. If we talk about going concern versus liquidation value, the asset-based valuation is close to the liquidation value approach. Then relative value methods. Here what we do is identify ratios that are appropriate for a given set of companies. For example, we believe that for a particular set of companies, the price earnings ratio is the most important. Then what do? We look at comparable companies, and let's say that the average PE ratio for comparable companies is 10. Then we take our target company. Let's say that our target company has earnings of 5. We then use these two numbers to say that the value of our target company should be 5 into 10, which is 50. Why is this called relative valuation? Because this number of 50 is being arrived at based on the PE of comparable companies. This is not based on the fundamental attributes of the company that you are evaluating. Valuation of total equity and its components. Now here is another aspect that we will look at. Sometimes you might be evaluating a large company with lots of different business units, and those business units might be quite different from each other. The dynamics might be different. You can take a company like General Electric, which has a financial services division, an aircraft engines division, medical supplies division. Obviously, those businesses are very different. So it might make sense to take each business separately and value it using an appropriate method. When you do that, what you are doing is a sum of parts valuation. There is an example that we will talk about related to sum of parts valuation. You also need to understand this term, the conglomerate discount. When I described GE right now, effectively what I was doing was describing a conglomerate. A conglomerate is a large company that is made up of several businesses or several segments that are quite different from each other. What many analysts believe is that when a company tries to do this, where it has several different segments, then inefficiencies creep into the business, and the overall value of this conglomerate might actually be less than the sum of the parts. In other words, what analysts do in this scenario is sometimes they apply a conglomerate discount. So if the sum of the parts is 100 and the overall company is being valued at 98, then the conglomerate discount here is 2%. Does this always happen? Not necessarily. Probably in the case of GE, it doesn't happen because the company is known to be extremely efficient and really good at managing different businesses, but you need to understand this term. As a side remark, you will often see in the curriculum that when a company tries to diversify itself by taking on different kinds of businesses, that is often frowned upon by the investment community. We as investors believe that every company should generally focus on what it's good at and leave the diversification to us, the investors. Here is a classic example of asset-based valuation. The reason I picked this example is that we have full-fledged readings on the other methods, but we do not have a reading on this method. So I want you to read this quickly and then I'll make a few remarks. So there are two main points here. If you are looking at a company where you believe that a large chunk of the value of that company comes based on its assets, and this would often apply to natural resource companies, then you can use the asset-based valuation method. And there are a couple of examples that are given here. But also keep in mind that today, very few companies actually fit this description. Even a company that is called Occidental Petroleum might have one division where most of the value comes from petroleum, but it might have several other divisions where the value cannot simply be calculated based on the value of the underlying assets. We come now to example 7, sum of the parts valuation, and I've emphasized this example because it is mentioned in the learning objectives, and this is not something that you will see in other parts of the curriculum. So I want you to read this. So note that we are talking about Schering-Plough in 2007, and this particular company has 3 business units which are quite different from each other. So human prescription, which is quite different from animal health, which is different from consumer healthcare. Here we are shown the net sales. In the next exhibit, we are shown the net income for each of the different businesses. Do you think it makes sense to use sum of the parts valuation? It does, because each of these segments is fairly different. So rather than trying to value the whole company together, it might make sense to take each of these divisions and value them separately. Another point is that if you take 2007, two of the businesses made a substantial loss. So can you use a price earnings method over here? Probably not, unless you make some adjustments. So not only are the businesses different, but at times you just cannot use the same model. Also note this little point. We had one division where the loss includes a 3.4 billion amount related to in-process R&D. This is a pharmaceutical company, so a substantial amount of money gets spent on R&D. And the quick story over here is that when these numbers were reported, US GAAP required that any in-process R&D be expensed straight away. Later, the rule was changed where US GAAP allowed companies to capitalize in-process R&D. So what do you think was the impact on net income of expensing the entire in-process R&D? That probably had a substantial negative impact on earnings. So when you as an analyst value this company, you need to keep in mind that this was a one-time expense that needs to be addressed. So here are the questions. You can read these, but I'll emphasize the main points. Why might an analyst use the sum of the parts approach to value sharing plow? We've talked about this. Since the company has three very different businesses, it does make sense to use this particular approach. The other part two, I would want you to read, and then the solution is on the next page, which I will show you briefly. So this is not very difficult. Again, it is being emphasized why sum of the parts approach makes sense. That's indicated over here. In solution to 2, we are talking about the 3.2 million in-process R&D expense. And the main point being made is that as an analyst, you should pull out this expense because it is not something that will recur. Moving to issues in model selection and interpretation, and this is very testable. How do you figure out what model to use in what circumstances? The model that you come up with should be consistent with the characteristics of a company. You cannot apply the dividend discount model to all companies, especially let's say that you have Microsoft in the 1980s or early 90s, did not pay any dividend, but was profitable. Can you apply the dividend discount model there? Obviously not. Would you use the same model for a bank and a consulting services company? Obviously not. With a bank, a lot of value comes from the assets and liabilities of the bank, most of which is actually visible on the financial statements. What about the value of a consulting services company? Where does the value of this sort of entity come from? It comes from the intellectual capital that this company might possess, which is not reported in financial numbers. So clearly they are going to be different models. Also, you need to consider the availability and quality of data. I've already talked about the dividend discount model. The PE method, which is a relative valuation method, is quite popular. But can you use the PE method for a company which has negative earnings? You cannot. The PE makes no sense when earnings are negative. The valuation needs to be consistent with the purpose of the valuation. So for example, if you are a large company that wants to acquire a small company and then you will take control of that company, then does it make sense to use the dividend discount model or the free cash flow to equity model? It makes sense to use the free cash flow model because once you acquire, then you can control the dividends. It makes more sense to use this model. And when we talk about free cash flows in a later reading, there you will also learn when to use FCFE versus when to use the free cash flow to firm. How do you convert forecasts to valuation? The point here is that let's say that you have a nice forecast of sales, nice forecast of cash flows and earnings, nice forecast of your balance sheet elements. Do you simply plug those forecasts into a model and get a value? The answer is it is not that easy. Obviously, you need to do this, but there is more than that. One is you should do a sensitivity analysis. When you feed numbers into a model, you are making several assumptions. If you take the simplistic Gordon growth model, what assumptions are you making? A major assumption is an assumption related to the growth rate. Also, you are making assumptions based on which you are coming up with the cost of equity. You are making assumptions about the upcoming dividends. So, you need to do a sensitivity analysis that looks at the impact on value of changes in these assumptions. You also need to take into account what other competitors might do. All right, so this is not that easy. And do you see why having knowledge of the industry is critical? The intelligence with which you do sensitivity analysis and the range of, say, growth rates that you take will be based on your knowledge of the industry. You might also need to make some situational adjustments. And here are some terms that are mentioned in the learning objectives. Actually, these terms are touched on briefly in this reading and then in more detail in subsequent readings. A control premium. Sometimes when a large company buys a small company and takes control, then the larger company can maybe make the smaller company more efficient, and therefore the value that the large company pays might be more than the pure market value of the small company. That additional amount that is being paid can be thought of as a control premium. So if you have big company buying small company, then one element of the price will be the control premium. On the other hand, if you are a small shareholder and you are buying shares in this particular company, separate transaction, then would you pay a control premium? You would not. Because just by buying a few thousand shares, you are not going to control how this company operates. Two other terms which are somewhat related: lack of marketability discount and illiquidity discount. What does this mean? Let's say that you are a large investor and you are buying a private company. Okay. One of the issues with buying a private company is that your investment now is not very liquid. So you buy a private company. If you want to sell it next year, are you sure that you'll easily find a buyer? Not necessarily. So is this investment liquid? It's not. Since the investment is not liquid, all else equal, let's say all else equal means that you determine a fair value of 100. Because this investment is illiquid, will the actual amount that you pay be more than 100 or less than 100?
Yes.
It will be less than 100. So that is called a lack of marketability discount, because this particular investment is not very marketable. As I mentioned, a related term is illiquidity discount. You buy a public company, but not all public companies are heavily traded on the stock market. So when you buy a relatively illiquid stock, then should you pay a little more than fair value or a little less than fair value? There again, you should pay less than fair value. So when you pay less than fair value because the stock is relatively illiquid, then the differential is called an illiquidity discount. We now come to section 3.5. This is not really mentioned in the learning objectives, but I think information here is useful, so we will cover it briefly. Different analysts or different groups come up with valuation, and there are different users of that valuation. For example, here are some of the important terms. Sell-side analysts. Where do you find sell-side analysts? These are people who work in brokerage houses, and brokerage houses will typically have a research department, and that research department will come up with research reports on companies. And these are the ones that most people are very familiar with, because the brokerage houses use these research reports as a way to market their services, and these float around a lot. So that's what sell-side analysts do. These reports can then go to buy-side analysts or other investors. Who are buy-side analysts? These are analysts who work at large companies like, say, banks or asset management companies that actually use their research to make investment decisions. They need to decide whether to spend $10 million on so-and-so investment. So that's what buy-side analysts do. Do you note that there is a major difference between the purpose of a sell-side analyst and a buy-side analyst? A sell-side analyst is advising clients, and the clients might be a range of clients. A buy-side analyst is very concerned with his own organization and the decision-making process of his or her organization. Then you can have corporate analysts. You can have a large company like General Electric, which is evaluating a possible acquisition. So there'll clearly be analysts at General Electric who will try to value this proposed acquisition. And then you also have analysts at independent vendors of financial information. So you will have groups that actually do independent valuation. So that's a smaller category. The next point on this slide is that analysts play an important role in financial markets. Analysts help clients make better buy and sell decisions. Analysts help clients make better buy and sell decisions, contribute to the efficient functioning of capital markets. How do we as analysts do this? When we find securities that are underpriced, we buy until the price is efficient. And we benefit suppliers of capital by monitoring management performance. If management is not performing well, then we sell those shares, and obviously then the stock price goes down. Since we are all either analysts or aspiring to be analysts, it is good to have a positive feeling about the work that we do. You can, if you have time, go over example 8, which covers the concepts that we've talked about. As an analyst, once you come up with a report, obviously you need to communicate your results. This is not mentioned in the learning objectives, but from a real world perspective, it is extremely important to be able to write and present your findings. So I would encourage you to go over the template that is presented in the curriculum. The template is presented in Exhibit 2. This is the format for a research report. It's a proposed format. If you have time, go over this. If you don't have time, then make sure you go over this after the exam. And then this is the last part of the reading, which talks about research reporting responsibilities. All these come from the code and ethics. Clearly, there are certain ethical values that need to be followed when you do research. I'm not going to read this for you because this is material you have seen in ethics. And at level 2, there is also a reading on research objectivity standards, which connects with this. Now, a quick summary of the most important points from this reading. Here is a big one. There is a difference between the value that you as an analyst estimate for a given security and the current market price. This difference is called perceived mispricing. And perceived mispricing has two components. One is the true mispricing. V is the true intrinsic value. But the problem is this true value is not really known. The other component is the difference between the estimate that you come up with and the true value. And for you to be a successful active manager, this should be as close to zero as possible. And this should be positive on a consistent basis. Going concern value versus liquidation value. The default assumption is that we are using a going concern value, where we assume that a company will go on forever. Even financial reports are created based on a going concern assumption. Liquidation value is used where maybe you are evaluating distressed securities, and if the company is going out of business, then it makes sense to value the current assets. Also, recognize that for a normal company, the going concern value, so the going concern value should be greater than the liquidation value. If you take the simple example of equipment that is being used, with a going concern, the assumption is that you are using that equipment to make inventory or to make whatever you sell, and the selling price or the total cash flow that you generate, the net cash flow that you generate from selling, should be higher than the value of the machine itself. Or if you take inventory, in a liquidation scenario, what will you assume? You will assume what is the money that I get by quickly selling off this inventory? Whereas in a going concern, you will assume that you are selling the inventory through the regular channels at regular prices. Whereas in a liquidation, which is also sometimes called a fire sale, you might just be selling at very low prices. So keep this in mind. We talked about several applications of equity valuation. The two big ones that I will emphasize here are the following. One is to come up with the value of a security or the value of an asset. And the other is to use the current market price to infer some aspect of a company. And there I'll refer again to the Intel example, where we use the market price of Intel and some information related to Intel to impute or infer the expected growth rate that is built into the price which is currently prevailing. You need to understand industry and competitive analysis, and this reading highlights three critical questions that you must answer when doing an industry and competitive analysis. The first big question is, how competitive is the industry? How strong are the forces? If Porter's 5 forces are strong, then that means that in this particular industry, the pricing power is weak and the profitability is likely to be low. The next question is, what is the particular strategy of the company? In Porter's article, he talks about strategies like cost leadership, where a company is trying to provide good value at a low cost, or a strategy might be a differentiation strategy, where a company differentiates its product and sells at a higher price. And then there is always a hybrid, which is a strategy in between. So you need to figure out that the company you are evaluating, you need to figure out what strategy is being followed by the company that you are evaluating. And then the third question is, how well is that strategy being executed? So those are the key questions. You need to understand the distinction between absolute value versus relative value models and which models to use in what scenario. Absolute value models are like the dividend discount model or the free cash flow models, where you project some variable related to the company, and then you take the present value to come up with what the value of the company should be. In relative value models, you come up with the value of a company based on the value of other comparable companies. And here you would use ratios such as PE, price to cash flow, or enterprise value to EBITDA. So there are several methods within each of these categories, and we'll spend a lot of time on them in later readings. Sum of parts valuation is where you have a business that has several segments, and these segments are somewhat unrelated, and maybe different valuation methods are appropriate for the different businesses. So you value each part separately and come up with a total value. Then in cases you might apply a conglomerate discount if you believe that these combination of companies make the overall company somewhat inefficient. And finally, we talk about selecting an appropriate valuation model, and I've already alluded to this. Given the sort of data available and the nature of the company that you are evaluating, you need to pick an appropriate model. So that is it for this reading. The usual advice is read the summary, review the learning objectives. Examples, do if you have time, especially do the ones that I have explicitly mentioned. Other ones you will note that those examples have considerable overlap with other readings. So I think it's useful if you can do it fast, but if you don't, then it's not a huge problem. Practice problems, I'll give you a word of caution here. There are two types of practice problems. They are the non-MCQ and the MCQ practice problems. Many people just skip the non-MCQ. I think that's not a good idea, especially for equity, because the non-MCQ questions are quite short, and even though they are not in MCQ format, but they cover concepts that are extremely testable. So I would strongly encourage you to do all the questions. They are not that many, but do them all. And then, as always, if you have time, try to do practice questions from other sources as well.